Hello, this is a short revision video on the Market Failure chapter of the Markets and Market Failure unit of Economics AS level with AQA. This video basically goes over all of the reasons for market failure in quite a bit of detail. Here is a list of the reasons for market failure. The first one is negative externalities, which are when social costs are greater than private costs, meaning that the good is overproduced, as these costs aren't taken into account. More detail on all of this later, of course. Second one is positive externalities, when social benefits are greater than private benefits, meaning that the good is underproduced. Imperfect information. Merit goods are underproduced and demerit goods are overproduced because people aren't fully aware of the impact of the production or the consumption of these goods or services. The inability to supply goods, because the private sector can't profitably supply public goods and quite a lot of quasi-public goods. Monopolies, because there's lack of competition which leads to underproduction and higher prices, and there are so many costs of monopolies, and we'll come to all of this later. The immobility of the factors of production. The big issue with this is unemployment, which leads to productive inefficiency. And finally, equity issues. Markets generate an unfair distribution of income. Market failure leads to productive inefficiency, and this means that there's a loss of output from inefficient production. There's also a misallocation of resources because people aren't fully aware of what should be produced if we're taking all of the costs and benefits into account, and this means that there's reduced customer satisfaction because not everything that the consumers want is necessarily produced. You've probably heard of positive externalities and negative externalities, and this is a basic definition of just externalities in general. Externalities are costs for negative and benefits for positive of production and consumption, and these spill over to third parties who are external to the market transaction. For example, if there's a factory that's producing PlayStations and it's emitting a lot of smoke, I'm not going to buy a PlayStation, I'm not part of producing the PlayStation, but I might suffer as a result of this factory if it's producing a lot of pollution. I'm a third party, I'm external to the market transaction, but I'm still suffering. So I'm the one that's getting the costs of the production, the negative externalities. For reasons that we're about to come on to, market failure is often a result of externalities because goods are either overproduced or underproduced when costs and benefits aren't taken into account. First, we're going to look at negative externalities. These occur in production and consumption. The big ones in both really are pollution, that's the one to look for, and then ill health is also another negative externality. There's a whole range of negative externalities out there. It's just something that's bad that has an impact on a third party as a result of production or consumption of a good or service. Negative externalities occur when social costs are greater than private costs. Social costs is the full cost to society of an economic transaction, so the impact on the individual or firm and third parties, and private costs are just the costs of the people involved in the economic transaction itself. This means that if we were looking at the actual social optimum level of output that we'd be producing, it'd be less than the amount that's being produced at the moment, because the individuals producing or consuming the goods don't take into account the social cost when the good's being priced or when they're consuming it. A few really important definitions are there are marginal private costs, marginal external costs, and marginal social costs. It's quite important to know these because they've been known to come up as the 5 marker in the definition section before. It probably won't come up again because it came up last year in 2013, but you never know, and they might come up in the multiple choice as well. It's also really important to note that marginal social cost is marginal private costs plus marginal external costs. So it's the cost to everybody in the economy, basically, the individual or the firm and all the third party. This diagram is really important and it shows negative externalities basically. So the market mechanism, which is the price or the output that's generated due to the market alone, is at Q1 and it has quite a low price. Now if we were looking at the actual social efficient output, which takes into account all the costs or benefits, this would actually be at Q2 for negative externality producing good, demerit good essentially. So it'd be less would be produced and it'd be at a higher price as well. So the shaded area there is the welfare loss that results from this negative externality not being taken into account. And welfare loss is essentially the decreased economic well-being of everyone in society. Positive externalities are basically the opposite of negative externalities. They're positive effects of consumption or production on third parties. They're less common. A really common example, though, is an injection, one of those things that prevents you from getting diseases. I've forgotten what they're called. Vaccination, that's the one. If I get a vaccination, the social benefit is that me being protected against disease means that I can't give it to other people, whilst the private benefit is just that I can't get the disease. So the social benefit is actually greater than the private benefit. But because the people that are selling these vaccinations and me, we don't know this, it means that the private level is actually below the social optimum level of output. So this vaccination is underproduced and undersold. So less people have it than should be having it. There are some important definitions down there. I'm not going to read them out to you because they're basically exactly the same as the ones for the costs, so it's just benefits instead. Again, it's very important to note that marginal social benefits is marginal private benefits plus marginal external benefits, which is the full benefit to society of an economic transaction. This diagram is for positive externalities. Now the market mechanism here is at Q1, which is actually a lower supply than the socially efficient output, which is what would be the optimum output for society. So if we did produce the optimum output for society, we would be producing more. Now it's quite important here to note that prices, they're on this diagram, but in the exam itself I wouldn't put them on because the price here it's higher when we don't really want it to be higher. It's hard to explain, but in the exam itself I wouldn't put the prices on. I'd just ignore the price axis. That's what we tend to do when we draw these. And the shaded area there is the welfare gain. It's the economic benefits to society of producing at the higher amount at the socially efficient output. When we're drawing this diagram, we assume that the marginal social cost is equal to the marginal private cost, and for the negative externalities diagram, we assume that the marginal social benefit is equal to the marginal private benefit. It just makes it easier to draw, and obviously in real life that isn't necessarily realistic, but at AS level economics, that's just what we do. Unless, of course, we get told that they aren't equal and we have to draw differently. But I think in most essay answers at least, they should be equal. You might get some that aren't equal when you're doing a multiple choice, but they'll already be drawn for you. Obviously there's issues with identifying and valuing externalities. How can we say how much pollution is a cost? How can we value pollution? How can we value the benefits of diseases not spreading due to vaccination? Stuff like that. But there are two ways that we can essentially value externalities, as it were. There's ex ante and ex post. So ex ante refers to a future event. So before the externality is going to take place, we estimate the amount of money that consumers are prepared to pay in order to avoid the externality. So we put quite a lot of money, we put like a tax on essentially, and we say, look, if we put this much money on, maybe consumers will be put off and we just avoid this externality from happening at all. So this ex ante is avoiding the externality, whilst ex post is putting the externality right. So the evaluations are done after the event and they estimate the cost of putting the externality right, so it actually happens. There's a lot of debate as to which is better, which is worse, but I don't think this is going to come up. It's a very small thing, so hopefully it won't come up. It's just some nice vocab to slip in if you're writing an essay about identifying and valuing externalities and stuff, putting stuff right, correcting market failure. It's just a nice bit of vocab you can slip in there. Moving on now to the importance of property rights. No one has the economic incentive to protect unowned resources from abuse. For example, no one owns the fish in the sea, they're just fish. So loads of people fish them and essentially fish are going to die out because we're overfishing them. That's called the tragedy of the commons. That's why it's really important to assign people to properties, make sure there's property rights so that we don't abuse these resources, because otherwise future generations aren't going to have them and that's not really fair. Moving on to information failure, merit goods and demerit goods. Information failure is when the economic agents don't perceive the benefits or costs of transaction. For example, someone smoking a cigarette may not fully appreciate that it's got quite a serious effect on health and also the cost that this is going to have, for example, on taxes, the NHS, because obviously if lots of people smoke, they get lung cancer. Not everyone who smokes gets lung cancer, but quite a few people do. That's a massive cost to the NHS, everyone has to pay more taxes, that sort of thing. Merit goods are goods with positive externalities, and demerit goods are goods with negative externalities. We've already had some examples of these. Public goods, it's really, really, really important not to mix up public goods and merit goods. This always comes up in multiple choices, just make sure you don't get them mixed up. A public good is non-excludable and non-rival. Non-excludable means that those that don't pay benefit for no cost. So say you put a street light up outside my house and I've not paid for it or anything, I still benefit from it despite the fact that I haven't paid. And then non-rival means that consumption by one person doesn't reduce availability for another. So say there are, I think, radio waves. As many people as you like can listen to the radio. So say I suddenly start listening to the radio, it means that there's no lack of radio for you. Everyone can still use it. Whereas say we're doing a good, like a private good, say that we're selling phones. If I buy a phone, it means there's less of a phone for you, because obviously not everyone can have a phone unless we produce more. A quasi-public good is a good that shows some of these characteristics, but not all of them. An example of a quasi-public good is roads, because although roads are non-excludable essentially and non-rival to an extent, after a while, if everyone's on the roads, they get congested, which means that they are rival, because consumption by one person means that another person's car simply cannot get onto the road. We also come across the free rider problem here, which means that some consumers benefit from other consumers purchasing a good. For example, if I live next to my neighbour buys a lamppost to put outside our house to prevent us from, I don't know, crashing when we're trying to turn into our drives, I benefit from his lamppost without paying. And obviously this means that people might feel, oh, I don't really want to buy a lamppost because it's not really fair that she gets to benefit when she doesn't pay. And thus this is a form of market failure. Private goods are goods which are excludable and rival in consumption. For example, I've got a book in my hand right now. If I buy this book, it means that not everyone else can buy it because I've already got it. So there is a limited supply, and it is also excludable because bookshop sellers can prevent you from buying it or benefiting from it if you haven't got the money, because they can say, you've got to pay for this book or else I'm not going to give it to you. So it is excludable, and it's also rival because me having it means that you can't have it. Moving on now to Monopoly as a market failure. Everyone played Monopoly as a kid. It was the best game. I was always the dog, and I just loved to get the orange set. Anyway, Monopoly in economics, unfortunately, isn't quite as exciting unless you absolutely adore economics like I do, in which case it's a really exciting idea. So Monopoly is a market structure which is dominated by a single seller of a good. I mean, you don't get too many of those. I suppose you might get a pharmaceutical company which is the only one in the world that produces one pharmaceutical drug. That would be an example of Monopoly. But you don't get too many of those. What's much more common is monopoly power, which is when a firm has 25% plus market share. I'm not sure if it still does, but Tesco definitely used to have monopoly power. It might do, because I think it does have over 25% market share. You get monopoly power in quite a lot of different industries. Quite often it makes sense for you to have a monopoly in an industry because it'd be far too complicated to have lots of different companies providing a service. For example, postal service, when it was Royal Mail. Is it still Royal Mail? I've got no idea. But when Royal Mail was doing its thing, actually I think Royal Mail is still a monopoly, pretty much. Well, it's much easier to have just Royal Mail delivering post than to have thousands of different companies all delivering post. It just doesn't make sense to do it like that because of the space, the time, and all the resources that it requires. Another common monopoly will be lots of local water companies will provide you with water and electricity, because it doesn't make sense to have lots of different companies with lots of different power lines. There are actually quite a lot of advantages of monopolies, although I'm not sure if they are outweighed by the disadvantages. It's up to you to decide. It could be an essay question you might get asked. The big advantages are on the screen now. One of them is that firms can take advantage of economies of scale. Because monopolies tend to be much bigger than normal firms, they've got economies of scale they can benefit from. We did economies from scale in the efficiency video, I believe. And these lead to lower average costs, which means that the firms could reduce prices or increase profits. If they reduce prices, obviously that's really good for the consumer because lower prices are always a good thing. And also it could increase its profit, which means it can pay its employees more. Or if we move on to the next one, it's high profit. It could put it back into research. It could develop new products which are always beneficial for the consumer. It could develop new methods of production which are more efficient, better for the environment, that sort of thing. Also, large UK firms with monopoly power are more able to compete on the international market due to their lower average costs and stuff like that. And this could lead to a reduced balance of payments deficit, essentially, for the country. If we've got a really good big firm out there bringing in lots of money through the selling of exports, that is good because we get a lot of money in corporation tax as well. Moving on now to the, alas, much longer list of disadvantages of monopolies. High prices, poor quality, less choice, less innovation and less efficient, they're all due to the lack of competition. Because they've got no one to compete with, so they may as well put their prices sky high. Poor quality, because there's no one to compete with on quality. There's less choice for the consumer as well, because they've only got one person they can go to. So that's kind of bad. It discriminates against people, because people simply have no choice. Monopoly people can get quite relaxed, so they don't bother to innovate because there's no competition. People have to keep buying this product, which isn't very good if you're trying to compete on the world market. If this is the UK firm competing on the world market and it isn't innovating, it might fall behind, not very good. And less efficient, that's obviously bad for the environment, bad in general because we're using our resources inefficiently. Monopolies tend to pay their workers not very much and have people right at the top making millions, billions. We call these people fat cats, meow, because they're fat. Or they're not fat, but they're just taking all the milk from the workers. I've got no idea why we call them fat cats. I mean, I can visualise it in my head, but I can't explain it, so let's not. And finally, these monopoly people can put up barriers to entry, because if someone new is going to enter the market, they just put their prices down to rock bottom, and this just pushes out any competition, because they can afford to do this because they've got saved up profits and lots of organisation and stuff. But if someone new's coming in, they've got really high startup costs, they can't afford to go this low, so they get kicked out of the market, which isn't really very good for them. On a more positive note, recently there's been a massive rise in competition due to technological improvements, globalisation, and government policies designed to open up markets. Technological improvements, particularly the internet, means that anyone can become a seller from the luxury of their own home. So anyone can just pop onto eBay, start selling stuff, make dollar. I always cringe when I say stuff like that. But it simply means it's harder for one firm just to take total control of a market, and more people come in. Obviously, if there's technological improvements, it becomes cheaper, lower startup costs, stuff like that. Globalisation means that firms face competition from abroad, so it's harder for a firm to gain total monopoly power when people can simply buy cheaper products from abroad. And there are lots of government policies designed to open up markets, so they might subsidise firms coming into the market at the start, give them grants to reduce their startup costs. Government also has different schemes in place to prevent mergers and takeovers which could not be beneficial for the market. They might have a negative impact on the market because they might lead to monopoly power and stuff like that. I believe there's something called the Competition Commission which is in charge of that, but you might want to check that because I'm not 100% sure. There's also the issue of immobility of factors of production. This is another reason for market failure, and the biggie here is labour. There's two different types of immobility in terms of labour, occupational and geographical. Occupational immobility, I keep saying immobility is when workers lack the necessary skills in order to secure a new job. So say I'm working in accountancy and suddenly the accountancy industry collapses and I want to go work as a miner, if Margaret Thatcher hadn't closed all the mines, but say I did want to go do that, I can't do that because I simply don't have the skills to work in a mine. I've got no idea how to blow up mines or whatever you have to do in a mine. So I'm stuck, I'm unemployed, and basically the economy isn't using me, so I'm not being fully utilised, which means that there's inefficiency within the market and thus market failure. Another example of immobility is geographical immobility. I'll find it hard to move to get a job due to stuff like family ties, differences in housing costs. There might be loads of amazing jobs in London, but if I can't afford to live there because housing is just so expensive there, I'm not going to go move, which means I'm going to be unemployed, and thus it's going to have a negative impact on the market because I'm not being fully utilised. This sort of thing tends to come up in the multiple choice questions rather than as a big question, but it's still important to know. The final reason for market failure is the unequal distribution of income and wealth. Income is the flow of earnings to a factor of production over a period of time, for example, wages. If you want more detail on that, then go to the first video I made for microeconomics AS level, and there's detail on the incomes for all the factors of production. And then we have wealth, which is the stock of owned assets. So, for example, if I own shares, that's wealth for me. And due to a whole load of reasons, there is inequality in income and wealth. For example, some people are born into rich families, so they inherit loads, they get really wealthy. Some people have better jobs, they've got greater income. Some people are given houses by rich relatives, stuff like that. And inequality leads to alienation, because people think, I'm so alone, I can't afford anything, and all these people can afford stuff. You know what I mean? When you're sitting there and everyone's there with their iPhones and you're just there with whatever you've got, your rubbish phone. My phone's pretty rubbish, it's here. It does its job and I wouldn't want to pay any more, but everyone's got their iPhones, I'm here like lol. See, I did get really jealous of all these iPhone people. I might start stealing iPhones, so I'd have an iPhone of my own, so this is crime. Or I might start stabbing people with iPhones, another crime that's often committed due to inequality of wealth. People in more down, I don't know what they're called, downturned areas that have got lots of poorer people in, that often gets higher crime rates in those areas due to the inequality in income and wealth. And also there's just unfairness in the economy. People don't think it's fair. It's not fair if I've got a house and you don't, or if you've got a house and I don't. I mean, this is the beliefs of some people might not believe that, but it's generally believed that it's not 100% fair, that some people just have so much more money than others, and that is market failure. Woo! That is the end of the market failure, sort of the causes, the types of market failure video. Next time we'll be moving on to the ways the government can correct market failure. How exciting! Hope you could keep up with my voice there, I went quite fast in that video. Have a lovely day. Bye!